Well, hi everyone, Shaun here. I wanted to produce this screencast video basically looking at a piece prepared by Richard Wiley, a chartered financial analyst and vice president of investment strategy with Assante Wealth Management. This piece is fairly recent. It's called The Big Picture, and I think it's a great overview on some of the main market themes over the last several months. So what I'm going to do in this screencast video is just highlight some of the main themes, and then I would encourage you to view the document on your own. You can print it off. It's linked to our website, and if you're viewing this particular video on our YouTube channel, All Things Retirement, there'll be a link under the notes that you can just click, and it'll take you to the ability to get a hold of this document. Okay, so let's talk about some of the major themes. Probably one of the big frustrations for Canadians has been the lagging capital markets of late. And as we go through this discussion, it is really going to underscore the importance of diversification when it comes to designing and managing portfolios. This notion that we can somehow be tactical and forecast in the future which market's going to give us the best performance is a really flawed idea. And for most of you, what we're trying to get is consistent performance to manage downside risk or short-term declines in the portfolio, smooth out those patterns of return. And you do that through diversification. Now, what's the downside of diversification? Obviously, if you're underweight a particular area that does really, really well, you're going, I wish I had more money there. But again, the probability of figuring out which sector, the economy, geographic area is going to do well is a statistical improbability if you're trying to do that consistently over time. So this first paragraph basically talks about the diversion of performance between the U.S. market and the Canadian market over the last year, and a lot of the diversion of performance has been generated because of expectation, I think, more than anything else in the U.S. economy with Donald Trump's election back in November 2016. So whether or not you like Donald Trump or his policies, the capital markets actually like some of these policies. So that's what was driving some of the underlying growth. This particular chart just goes over what's happened with the Canadian market going back to January 2014. We've seen it kind of doing some ebbs and flows. Of course, we saw a real decline in energy prices through this period. In fact, if you look at the two largest sectors of the Canadian capital markets, it's the oil and energy sector, and then we've got financials, and when those areas struggle, then you can have an index that's not doing very well. Over the last little while, we've seen some improvements, and what this chart doesn't cover off, we're sort of doing this in October, we've actually seen the emergence of some increased growth in the Canadian market due to the fact that there's been some great earnings, not earnings, but growth numbers that have come out for the Canadian economy. So in excess of 4% GDP, which is basically 2% higher than the annualized growth that just was announced in the U.S. market. So things are beginning to turn around finally, but this kind of gives you a basic idea for what's been going on in the Canadian market. If you look at U.S. equity since 2014, we saw a consistent run. Again, there was a period of correction through the early part of 2016, the latter part of 2015, and then the market just continued to improve. So again, what was going on there? Well, if we go to 2016, we had the Trump bump, and Richard Wiley goes on to talk about some of the factors driving that. So this is old news, but again, you've got corporate tax cuts have been proposed in the U.S., deregulation. So again, people may not be in favor of that, but that can be a driver of short-term economic growth. Infrastructure, spending, and of course the repatriation of foreign profits. So U.S. companies have been almost incented because of the high corporate tax rates in the U.S. to keep money offshore. And so a lot of these policy initiatives have impacted the market. The market has sort of been rising on the expectation that this legislative agenda would take place. And so although there's been improved economic growth in the U.S., like I said, a lot of this has been driven by that expectation. If you look at economic performance, this is kind of an interesting chart. So just recently, the Canadian GDP numbers came in at 2% for Canada, and in the US it was around 2%. So 4% for Canada, 2% for the US. But if you look at the GDP growth rates going back to 2014 and thereafter, every single year from that time period, the US has been in positive economic growth. But in Canada, we've actually seen 3 specific periods when we've been in negative growth periods. So again, when you're trying to look at the differences between the US and Canada around growth, the numbers tend to support a rising stock market more effectively because the U.S. has emerged out of the recessionary cycle more effectively. And part of that has to do with it being a more diversified economy. Again, we keep coming back to the Canadian story, which is a story dominated on our capital markets by the financials, the banks and the life and health insurance companies, and of course the energy sector, which has had a much more difficult time. When we look at interest rates, this is an interesting chart to kind of give you a historical perspective on what's been happening with interest rates. The blue, of course, is U.S. rates, which were extraordinarily low. You look at below a quarter point bank lending rate, and you look at Canada at 125. Canadian rates actually began going down. We got down to 75 basis points, extremely low rate at this point, and we've been at that rate for quite a long time. As the U.S. market began to improve economically, as outlined by this chart, and it was a consistent trend, you began to see U.S. interest rates beginning to go up. And so they got to a point where U.S. rates were actually higher than Canadian rates. And it's one of the reasons why the Bank of Canada likely raised rates. Try to stem the flow of capital from Canada to the U.S. as asset managers are trying to get better yield. So if an asset manager can get a little bit more return in the U.S., buying U.S. Treasury bonds in a very large economic zone, there's a high probability they're going to do that, because if you're getting less of a yield in Canada, in a much smaller country with a smaller amount of outstanding currency and a smaller capital market, it's understandable that money would flow out. So the Bank of Canada sort of jumped in, and that's probably one of the reasons we saw that rise in interest rates, because it certainly couldn't be justified based on great growth and inflationary pressures. Canadian dollar and oil. So again, if we look at Richard's discussion here, we go into it a little bit. But again, if you look at the dollar, we were hovering above 90 cents back in 2014. We hit a low ebb of in the 70-cent range, and we've just kind of been bouncing around. Of late, we've seen some improvements, and of course, we're above 80 cents at the time of this recording. So we'll probably see some continued incremental improvement, just because generally the global economy is beginning to turn around, and that's putting more demand on Canadian commodities. We probably won't see significant changes to energy prices, but we'll maybe see an incremental increase. And so the story will probably be some, maybe slow incremental increases to the Canadian dollar. I'd say likely most economists and portfolio managers would say fair value for the Canadian dollar might be in the range of 81 to 83 cents. So we're not expecting a huge rally from this current level, but of course currencies are notoriously tough to call in the short term. Of course, a big story this last few years has been oil prices. And you can see from the highs here back in 2014, oil prices just cratered. And we've been sort of going along at a fairly consistent pricing range. The challenge for, of course, oil prices is there is a global, I wouldn't say glut of supply, but there's lots of supply of oil in the global economy. We've had new players come online, whether it's Iraq or the Iranians. Russia's retooled. The Saudis and the various Arab-producing countries are no longer trying to reduce production to try to boost prices, because they have now more competition. In the old days, when they did that, they would get a little bit of price increase by reducing production. But what they find now is that when they reduce production, that then puts other competitors in the market. They lose market share, and they never get back that entire market share again. So there's just a lot of capacity through more production and technology, which is putting more energy online. So we could be in a long period of lower energy prices. Now that's very good for the global economy. Low energy prices end up being a giant tax cut to the global economy. Not as great for countries like Canada, which are resource rich, obviously are provincial governments and the federal government, and looking particularly at Newfoundland and Alberta as an example, really rely on strong energy prices or commodity prices. So obviously it's putting pressure on those governments. But from a global economic investor standpoint, low oil is not necessarily a bad thing. So when we look at the big picture, this again just illustrates what's happened with energy over this last little while in terms of market value. Financials kind of went sideways, but of late we've been seeing some improvement in financials, and so there's some discussion on those two sectors, which are a big part of our market. What are Richard's conclusions? Well, first of all, one of the reasons for the outperformance of U.S. equities is anticipation of corporate tax reform, a reduction of corporate tax rates. It's unlikely that the Canadian government will be doing anything in that area. In fact, the raging debate right now is actually going the opposite direction, is to increase corporate tax rates. So we seem to be a little bit out of sync with where the U.S. is going. Not likely a good thing. We don't operate in a vacuum. So if we see tax policy that is regressive as it relates to the Canadian small business market, that just favors the U.S. and it could lead to more anemic economic growth, from that perspective. So it depends on what side of the fence you're on, but I'm on the side of the fence that small business and business in general need retained earnings and a fair corporate tax rate to reinvest for the future. And to walk away from that takes one of the major drivers out of the economy. If we look at the second point, Canada's underlying economic performance has been disappointing compared to the U.S. It's beginning to incrementally improve. I doubt that we'll see major increases to interest rates in Canada. We'll see some incremental changes, but the debt levels are so high that that'll be a muting factor on interest rates. In general, for investors, it's been a challenging period where bond prices have been under pressure. Obviously, the Canadian market struggled until of late, although the U.S. market did really well. The interesting thing is if I look at the year-over-year returns in the U.S. market, the U.S. was up roughly about 12%, and the Canadian dollar was up roughly 10%. So we've got a situation where as the Canadian dollar goes up, it actually reduces the paper value of your U.S. investments. If you're up in the U.S. 12, but your Canadian dollar is up 10, we have to reprice everything back to Canadian dollars. It dilutes some of the return. In saying all that, the portfolio managers have done, I think, a very good job of navigating through a very mixed kind of economic and market climate to still manage risk well and to generate competitive returns. And like I said, feel free to print this off, go through it in more detail if you want. If you have any questions, don't hesitate to contact our office. You can reach us at 204-977-8022. And the website, ShaunHumphries.com. You can send us an email through the website or offer your comments as well. Anyway, you take care. Hope you enjoyed the presentation. Bye-bye.